Okay, well, we'll sort of go back to Mahindra and Mahindra, but just a sort of quick slice of the conversation, the question answer session which is underway there. Sanjay Parikh is with us, founder and chief investment officer at Sohum Asset Managers. Sanjay, great to have you with us here as always on CNBC TV 18. Thank you for your time. I'll get to some of the themes that you like and you own, but I just want to start by asking you about banking for a quick bit, and specifically. SBI, which is the biggest bank in the largest in the PSU space, and HDFC Bank, the largest in the private sector space. Now, complete divergence, right? What's going on?
Yes.
We know the factors. Still a lot of valuation sort of difference, etc. But for HDFC Bank, do you think, around these levels, perhaps could be the right time to start accumulating if you have time on your side? A banker I was talking to made an interesting point, and I don't know if you'd want to reflect on that. He said, and by the way, we had his point was credit costs cannot stay this low. We had Amitabh Chaudhary of Axis Bank yesterday on the record telling us that how it can't go any lower. It has to rise, right? It's cyclical. These things are cyclical. It has to rise. And this banker I was talking to, he was making the point that when that happens, that is when people will start to see the quality of HDFC Bank's book and their sort of risk practices and underwriting skills, etc. And that will shine through. So just wanted your thoughts there. HDFC Bank, Sanjay.
No, Prashant, absolutely right. So one is, we look at Bank Nifty as a whole, and we do a bottom-up valuation. And, for a aggregate Bank Nifty, if you take an ROE of 16%, it's available at now 1.9 times on FY25 and 1.6 times on 1.55 times on FY26. So based on very reasonable valuation that we give, let's say for SBI at 1.3, 1.35, HDFC Bank even at 2.4, ICICI at 2.5, and so on, you still get almost 25% upside over 15 months because it's FY26. So one is clearly, I think the last 12 months has been underperformance, but the next 12 months, 12 to 15 months, we think will be positive. On HDFC Bank, I completely agree to the respected banker. That what is today exemplified is the liability side of, the deposit growth is not commensurate to the credit growth. And hence, some part of the asset side book will have to be reduced. And, and then it could be 1 or 2 quarters of transition. And that would mean a little less growth. And then it is back to square one. But, as you know, the NIMs and the efficiency would actually get better because some of the low yielding book will get shielded down. So I think it's quite a lot overdone. There's significant underperformance now. But at least, in my career, I have not seen HDFC Bank at 1.8 times now for 25 and 1.6 times 26 for at least 16% ROE that they'll do next 3 years. So I think it's quite overdone, and I think it's a matter of time. It will be a transition of 1 or 2 quarters. Once the liability side also gets better, I think it will be a good compounding story.
Sanjay, I just wanted to come in now because we're talking about HDFC Bank. I was just looking at, some part of your portfolio where the other banks, in comparison to their weightage on the index actually is relatively higher. I think IndusInd Bank, J&K Bank, ICICI Bank, out there you have a larger weight in your portfolio in comparison to what it enjoys in the benchmark. So incremental money that you have to allocate now, would you now start allocating to HDFC Bank because relatively actually you're underweight in comparison to the benchmark?
No, yes, we are underweight and it has helped us, and we have big overweight on SBI. As you know, we have 7% in SBI, which it took time for it to reflect, but it's always non-linear. You saw almost a 9 months consolidation for SBI, and within 2 weeks it gets a catch-up. And that's exactly what I think even can happen to the banking sector, where you could have a 1 year underperformance and then just 1 month and it'll just catch up. And it does happen. So yes, you're right. We are overweight on SBI, ICICI, Axis Bank, IndusInd Bank, and underweight on HDFC Bank. But I really feel from here on, it makes sense to increase the weight on HDFC Bank. Whether we will do, it's just a little bit of our internal positioning, but I still recommend that this is a good time for patient investors to invest with a little longer term time frame. And this is even, it could reflect even in 1 year. You don't have to wait for 2-3 years, is what I think for HDFC Bank.
Okay. Sanjay, hi, good afternoon. Just looking at all the PSUs, which are obviously getting really confusing now. And the moves are interesting. Actually, IRCTC, which had great numbers, the better numbers, that stock hasn't reacted that much. It hasn't even run up as much as the others. But a lot of the other names, look at SJVN. SJVN had a weak performance in the third quarter. The stock was slammed for 1 day. Then it started recovering again. And then you have the others, of course, the likes of Hudco, etc. What is the approach you're taking to, and then the railway stocks, forgot to mention them. They are running back to their winning ways as well. What is the approach you're taking? What do you have in the portfolio right now if you do? PSUs, X of PSU banks? And what is the advice?
We own HPCL and BPCL, which has worked very well for us. Both are up 70, one of them is up 100% after dividend yield, and BPCL is up 75%. And you've got a dividend yield at your cost of almost 5 to 6%. So it's worked very fabulously for us. And here, I think on both of them, the core earnings, at not the advantageous gains that we have this year. This year, both could do 110 to 130 rupees earnings. And that is not sustainable, very clearly, because last year they had a loss. So the government did allow them to make profits in the first half. And we think that sustainably earnings of 60 to 80 rupees, because it's very volatile, so you can't have an exact pointed figure on both the stocks. But broadly, a figure on sustainable numbers of 60 to 80 rupees earnings is possible for HPBP. And the transition they are going through, where they're investing into infrastructure, the new energy space, battery, ethanol, gas, the whole distribution chain, and refining and marketing as well. So I think the transition is less appreciated, and I think over 2-3 years, there clearly are still room to grow in terms of the EBITDA and profit. The key is obviously after the election, there should be some clarity around the regulatory framework, which is important. So that's the way we are thinking about HPBP, and we are holding both of them. Having said that, they've run up quite fast, and I still recommend to be careful now because significantly run up. So it could consolidate for a while. On the other defense stocks, I think there's a lot of euphoria in certain pockets. One has to be very careful. And I think the retail euphoria is quite large there. And that is playing up where, one of the railway finance companies, what was not even at 1 time, is moved to 4 times, while HDFC Bank is at 1.6 times. So there is element of euphoria in railway stocks and defense stocks, certain pockets, and one has to be selective and careful.
Sanjay, just one name. I don't know if I think we have discussed it once sometime back. Or is this? I'm not sure if this is a recent addition. Fusion Microfinance. I'm just looking through the portfolio for stuff which has not done well. So there is some room. What is plaguing it, and what will cause it to do well? I mean, from a stock perspective.
So as you know, they had an exposure. So they're quite good and sustainable on basis. They used to do an ROA of 4.5%, and the leverage was around 5. So 21-22% was the ROE, and growing at more like 20% plus. But this quarter they had an exposure to Punjab, wherein certain institutions there have tried to sway in certain districts that you don't have to pay and you give us 100 rupees and we will see that you have a karja maaf and all that stuff. So that led to some element of collection issues, but the overall collection still was very impressive, and that is one area where they'll have to handle it well, and they've guided for a higher credit cost, and hence the stock is consolidating very clearly. The situation in terms of overall collection efficiency has to get better, and the situation in Punjab in certain pockets have to get better before the stock further goes up. So I think it will consolidate for a while and wait for the next line of in terms of collection efficiency and asset quality.
Okay. All right, Sanjay, thank you very much. Good to have you on the show as always. Appreciate you taking out the time. Thanks for being with us. Well, with that,